The U.S. stock market is on a roll. Stocks surged on Wednesday, marking a significant uptick in investor confidence. This came after the release of key inflation data, which has been eagerly anticipated by market participants. Investors are feeling optimistic about the future. Why? They believe the latest Consumer Price Index, or CPI, report points to a potential rate cut by the Federal Reserve. This has sparked a wave of enthusiasm. The Federal Reserve is likely paying close attention to these developments. Their decisions are crucial for the economic landscape. The CPI is a major economic indicator that helps gauge the health of the economy. It measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. It tracks changes in the prices of goods and services, from groceries to healthcare, giving a comprehensive view of inflation. This data gives us a glimpse into inflation trends, which are critical for understanding the purchasing power of consumers and the overall economic stability. The Fed uses this information to make decisions about interest rates, which can either stimulate or cool down the economy. Right now, the market is betting on a rate cut, which would lower borrowing costs and potentially boost economic activity. This excitement is driving the stock market higher as investors anticipate a more favorable economic environment. The optimism is palpable, and the market's reaction is a testament to the power of positive economic indicators. So, what did the CPI report say? Let's dive into the details to understand its implications. The Consumer Price Index, or CPI, rose by 2.7% in November. This figure is a key indicator of inflation, reflecting the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. This increase is slightly higher than the previous month, which saw a rise of 2.5%. Analysts have been closely monitoring these trends to gauge the overall economic health. However, it was in line with market expectations, indicating that the rise was anticipated and factored into economic forecasts. The core CPI, which excludes the more volatile food and energy prices, also rose moderately. This measure is often considered a more stable indicator of long-term inflation trends. These numbers are important for a couple of reasons. They provide insights into the current state of the economy and help policymakers make informed decisions. First, they suggest that inflation is under control, which is crucial for maintaining economic stability. A stable inflation rate means that the purchasing power of consumers is not eroding rapidly. This gives the Federal Reserve some breathing room to consider their next steps without the immediate pressure of runaway inflation. Second, it increases the likelihood of a rate cut. Lower interest rates can stimulate economic growth by making borrowing cheaper for consumers and businesses. The market is already pricing in a cut at the Fed's next meeting, reflecting optimism that lower rates will support continued economic expansion and potentially boost stock prices. The positive sentiment has spread across the major stock indices. The Dow Jones Industrial Average, the S&P 500, and the tech-heavy Nasdaq all closed significantly higher. The Dow, representing 30 major U.S. companies, experienced a solid gain. This broad-based rally reflects the optimism in the market. The S&P 500, which tracks a wider range of companies, also surged. This indicates that the positive sentiment extends beyond just the largest companies. The Nasdaq, home to many technology giants, saw a significant jump, highlighting the growth potential of the tech sector. Section 4. The Fed's Balancing Act: Inflation versus Growth. This is a critical issue that impacts every aspect of the economy, from the prices we pay for goods and services to the job opportunities available in the market. The Fed is facing a delicate balancing act. They must navigate the complex interplay between controlling inflation and fostering economic growth, a task that requires careful consideration and strategic decision-making. On one hand, they want to keep inflation in check. Rising prices can erode purchasing power, making it more difficult for consumers to afford everyday necessities. On the other hand, they need to support economic growth. A thriving economy creates jobs, boosts incomes, and improves living standards for everyone. Lowering interest rates can stimulate the economy. By making borrowing cheaper, businesses can invest more in expansion, and consumers can spend more freely. However, it can also lead to higher inflation. If too much money chases too few goods, prices can spiral out of control, leading to economic instability. The Fed has already cut rates a few times this year. These moves are designed to keep the economy on track, but they come with risks. the market is now eagerly waiting to see if they will cut rates again. Investors and analysts are closely monitoring every signal from the Fed, trying to predict their next move. The decision will depend on a variety of factors. The Fed will look at a broad range of economic indicators to guide their actions. These include inflation data, employment numbers, and overall economic growth. Each of these metrics provides crucial insights into the health of the economy and helps the Fed make informed decisions. Section 5. Corporate earnings add to the mix. Corporate earnings season is also upon us. This adds another layer of complexity to the market. Strong earnings reports can boost investor confidence. Conversely, weak earnings can send stocks tumbling. Several major companies have already reported their quarterly results. Some have exceeded expectations while others have fallen short. The market is closely scrutinizing these reports for clues about the health of the economy. Positive earnings surprises could further fuel the market rally. However, any disappointments could quickly dampen the mood.